This is Andrew Stotts, and we're going to get started with Valuation Master Class case study. And the question is, can the world's largest car maker handle the ESG pressure? Let's look at this in a little bit more detail. So, this is Andrew Stotts of A. Stotts Investment Research. Welcome to this Valuation Masterclass case study, where we dig into interesting stocks and their valuations. Today's company is Toyota Motor Corporation. I've had Toyotas for a long time. Many people have too that are listening. If you've had a good experience with a Toyota, you're probably a lot like me. My first car actually was a Nissan, and I just remember it was about 1985, 1980, roughly 1985. And it was just amazing to me how reliable that Nissan car was. But let's look at Toyota and understand the valuation. Now, remember, this is for learning purposes only. It's not investment advice or recommendations. So Toyota's got to focus on hybrids, and the world's not ready, in their opinion, for full EV yet. So there's three things to know here. Toyota has EV skepticism, electric vehicle skepticism. And right now, in a woke environment, in an ESG environment, they may continue to take a lot of pressure. And demand has rebounded, and that's making up for lost production since the global economic shutdown. An ongoing share price repurchase program has kept the returns alive. Without that, you'll see there are some issues. So what's the consensus say? Consensus says there's about 26 analysts covering the company, and basically there's about a 7% upside. So the recommendation is about a hold. PE ratio of the company is about 13 times, and the dividend yield is about 2.3. So let's get into it. Let's first talk about sales. Where is this company generating its revenue? So first thing is 88% automotive. They have different brands. We have the Hino and Lexus, Daihatsu, and Lexus, and really Toyota are the ones that we probably most know best, although there's a lot of Hino in the emerging markets like Thailand. And then there's Toyota Financial Services, which accounts for about 8% of revenue. So how does revenue break down by region? Let's look at it. The regional breakdown is 30% North America, 28% Japan, 16% in Asia, Europe's 13%, and then the rest is at 13%. So what's the story about this company? When you're valuing any company, you've got to understand the story. Well, here's some ideas. The first one, as I said, the EV skepticism could become costly in a woke environment. Toyota's president is well known for his critical attitude towards the electrification of cars. Remember, of course, Toyota has been a long-term leader in hybrids, but it's way behind in full electric vehicles. Akio Toyoda has said that basically when politicians are out there saying, let's get rid of all cars using gasoline, do they really understand what they're talking about? And part of his point, obviously, he's protecting his position. What is his position? A leader in hybrid cars. But you can also say that his position is the idea that with hybrids, you have a lot less of the issues related to raw materials and resources like graphite, lithium, and other rare minerals that are necessary. Also, he talks about the cost of actually creating these cars, the electric vehicle cars. So that's another aspect that he talks about. So Toyota has been falling behind competitors in battery development. Here you can see that Toyota has announced to allocate about $13.5 billion by 2030 to the development of electrical vehicle batteries. And look at the other competitors. GM and Ford have both said that they're putting in almost double that amount in less of the time. So really, you can see that Toyota is behind. Now, you can also just go on the internet right now, and you can see that Toyota has launched the BZ EV, which is a Beyond Zero electrical vehicle. So they do have one that's come out, and it's coming out for full production and for sale, I believe, the middle of 2022, but it's far behind the other competitors. Now, are they betting on the wrong horse? Look at some of the news articles here. Toyota bet wrong on EVs, so now it's lobbying to slow that transition, and how Toyota sneakily spreads anti-EV propaganda in Japan, and the anti-Tesla, why Toyota remains hung up on hydrogen, and Toyota forms Team Japan to help keep combustion engine alive. The company continues to bet on hybrid models rather than full electric cars. They're also betting on hydrogen is another one. It argues that there's no difference in environmental benefits. The manufacturing of batteries still causes too much pollution, and most of the energy cannot be supplied by renewable sources. And realistically, there's nothing wrong with Toyota keeping a portfolio of cars, and if they can continue to strengthen the internal combustion engine and the hybrid, they may have a series of solutions. Maybe something goes wrong with electric, and we find that there's just not the ability to power it. So let's talk about the number 2 point, and that is that demand rebound makes up for lost production. Here you can see that demand was hit in 2021, and now it's recovering in 2022. Strong demand from the US and Asia is bringing back car sales almost back to normal by 2022. All production plants have returned to full capacity now, and management is forecasting that the company should return to about 10 million vehicles by the end of 2023. I remember when I was a young guy in Thailand, and I just mentioned this story. I came to Thailand in 1992. I had been studying finance, but also statistics. I had been studying with Dr. Deming. I had a chance to study in 2 of his seminars, and I was studying statistical quality control. So when I came to Thailand, I was asked to talk about just-in-time inventory management. So what did I do? I took my students out to a Toyota factory in Thailand, and it was amazing. That was 1992, 1993, and at that time, Toyota was just really building out in Thailand. And at the time, it was a huge number of Japanese managers, but man, that has changed now with those managers training the Thai staff, and now the facilities are amazing. So let's just look at this in a little bit more detail, right? The target may be a bit ambitious to get back to the 10 million, but not bad. Now here's number 3, and that's the ongoing share purchase program, which is keeping the returns alive. You can see that blue line. That blue line is the ROE, and the ROE, as you can see, is basically on the right-hand scale, and it's at 10. Now, in 1997, Toyota implemented its flexible share repurchase program, and despite the pandemic, it stuck to that strategy. The company announced also that by March 2022, it will buy back shares worth about $1.3 billion. So the repurchase has helped to keep the return on equity above its target. Of course, we don't want to see return on equity in companies only being driven by the fact that they're reducing equity, but that shows a commitment to try to deliver. Now, as we're talking, I see we've got a comment from Avi. Avi, great to see you. And here, Avi says there's a few points. Let me just pull this up so that the readers, the viewers can see this, because I think it's a good comment here. There's a few points that are right on. If the energy is coming from dirty sources, then wouldn't EV cause more emissions than hybrids? Yeah, I mean, I think that's the point from Toyota's perspective. They're perfectly positioned to be in internal combustion engine, hybrid engine, and electric vehicle. And if you can be in all 3 of those, you can diversify your portfolio, and also you can try to minimize your waste. And ultimately, that's really what we want. Obviously, we want lower CO2, but we also want to minimize the waste. And this is the reason why, Avi, what I'm saying is that, can they survive the ESG pressure? They're getting a lot of pressure. And just today, I was just looking at their new fully electrical vehicle that they've just put out. And I think that is, looks pretty interesting to me. And it just shows that, yeah, they've got to be positioned in electrical vehicles to some extent. Now, since this is teaching, I have a time that I talk about what's Ask Ajahn Andrew. And for those people that aren't from Thailand, Ajahn means professor or teacher. So the question is, does it matter whether the company pays dividends or uses share repurchases? Now, in theory, the effect on total shareholders' wealth is the same between dividends and share repurchases. In practices, there's few advantages. Repurchases are more flexible and they're not a long-term commitment. Also, capital gains tax is generally lower than taxes on dividends. So they prefer to do a buyback than paying dividend. And with repurchases, companies can signal that they perceive the stock price to be too cheap. In other words, the point is that companies should want to buy back shares when they think they're below intrinsic value. And finally, with dividends, everybody must receive the cash. But with buybacks, only those who want to sell their shares will receive the cash that the company's paying out. Now, I have written a short article about this. You can scan the QR code, or you can also go to the link, which I'll just show in my article. So let's continue on. And remember also that you can download today's slide deck on Toyota. You can find it in the blog section on the valuationmasterclass.com, valuationmasterclass.com, or just scan the QR code. So now I'm going to look at the FVMR scorecard of Toyota. It measures a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements, which is fundamentals, valuation, momentum, and risk. And we look at it from a scale of 1 to 10. Of course, we want to be number 1. So let's look at Toyota here. And what we can see is that Toyota doesn't look that good when we compare it to about 2,370 non-financial companies in Japan. That's what we're comparing this against. And so what you can see here is that it may not be that attractive. And as we look at the different ones, it's a little bit less attractive. W means worst, B means best. It's kind of middle of the road on valuation. It doesn't look great on risk. And here we can see that momentum is where it does look good. So let's look at momentum in a little bit more detail. Here we can see that revenue growth for the past 12 months has been about 14%. Recurring EPS growth is up about 76%, and the operating profit margin has changed by 353 basis points, so 3.5%. That's good movement. And the share price has moved about 5.5 in the past week. And in the last 6 months, it's up about 21.8. Of course, the markets have been up very strong. So that's where we can see where the company is. From an FVMR basis, it looks to me like it's kind of middle of the road. Avi, thank you. Beautiful presentation. I have to go, but compliments. Yep, appreciate it. Now, let's talk about forecasts. So here we can see that consensus remains optimistic. What we can see is that there are basically 5 strong buys, 14 buys, and 1 hold. There's no sells or strong sells, and that's out of 26 analysts. And basically, we can see, of course, that analysts tend to not have sells or strong sells. The upside is 7.1%, so not really that much from the analysts. So they don't see much future upside. The stock price has shown some strong momentum recently, though. But analysts expect a strong recovery in global car sales. Let's look at the 3-year forecasts that analysts have made here. What we can see is that revenue growth is up about 13%. Then it's 9, then it's 4. So analysts are expecting the rebound this year and then steady at 9% and then coming down a bit at 4%. Net margin is about 9%, and that's pretty fantastic. So let's look at the P&L. What I've done in this section here is that I have, let me see if I got my marker. Yeah, this section right here, we've done a little forecast for 2022 and 2023. And from it, basically, you can see that Toyota has shown a strong first half 2022 with revenue aiming to hit about Japanese yen 30 trillion by the end of the reporting period. This is reported in Japanese yen, by the way. We can see the year end is March, so a little bit different from the typical US company. We expect that the company benefits further from post-pandemic recovery. So this is our forecast of what we're expecting. If we look at the balance sheet assets, the company's got about 12.5% of its assets in cash, which is pretty good. So they got a lot of cash. Part of it's supporting that growth in the payout. And then you can see that the net fixed assets grow in line with revenue, roughly. And that's coming from expansion of its existing production plants and investments in battery development. Now, let's look at liabilities for a second. The other item right there that you see as negative is where the treasury stocks go when the company buys back shares. So when they're buying back shares, it comes in as a negative there in that section. And that means it's reducing the amount of equity. And that's keeping the return on equity high, even though profits may be low. Now, I would assume that they're getting that lower return on equity at 10% because we're going through a difficult time. And over time, it should be able to rise. Now, also, the company set the buyback program to buy about 150 billion Japanese yen. We forecast buybacks to continue in the future as well. Now, let's look at cash flow. Operating cash flow was not able to cover investing activities. There's the operating cash flow. And in 2020 and 2021, it wasn't enough to cover, or barely enough to cover, let's say, in the case of 2020. But that should improve in 2022 as earnings improve. Also, the company pays out dividends on a consistent basis as well as the buyback. So it's slowly growing over time. The dividend payout ratio is almost constant at about 30%. Let's just take a look at a couple quick ratios. Pandemic hit the revenue. The global car industry rebounded. However, semiconductor shortages constrained growth in the short term. And this comprises a short-term drag on net profit margin. And what we would expect is maybe 7.9, 7.8 is what we're forecasting. The company targets to keep its ROE, again, as I mentioned, at about 10%. Let's look at the remainder of the ratios here. You can see Toyota is among the most consistent and most profitable car makers. And here you can see EBIT margin at about 9%. If you look at VW or GM, recently we also looked at Daimler, the margins there are much lower than Toyota's. The company has moderately high leverage, but I wouldn't say it's a big problem, particularly because look at the bottom of this table. You can see that the effective interest rate is so low that Toyota's paying almost nothing in interest. And therefore, I would say it's not a big issue. From a free cash flow perspective, we can see it's remained positive throughout the pandemic, and high investment expenditures requires a constant generation of strong operating cash flows. It also needs recurring cash to continue its buyback program, which is an important element in the company's strategy. But overall, I would say free cash flow looks to be improving. Let's talk about valuation. So here we can see that the consensus is saying about 9% revenue. Why don't we put in about 7.8%? Gross margin about 9%, net margin about 8%. I expect global car sales is likely to see some strong rebound. Profitability is suppressed in the short run by higher raw material prices and semiconductor shortages. Here's the assumptions that I've used in the valuation, which is the risk-free rate of about 0.5. That's in Japan. And then an equity risk premium of about 8%, which gives me an equity market return for the long term for Japan of about 8.5. And let's just say the company's beta is about 1. So that's a cost of equity of about 8.5%. The WACC is about 5.7 because they have a reasonably large amount of low cost debt. And that brings down the weighted average cost of capital. And then let's say we expect the terminal growth rate of about 3%. So using the free cash flow to the firm valuation method, what I come up with is about 2,226 Japanese yen as a base case price, which is an upside of only about 4%. So I would say it's not a raging buy at this point. And even if I went into my bull case, it would bring me up to about 2,309 or about 8% upside. And the bear case would say almost no upside. So what you could say about this company is that it's kind of fairly valued, but it also is probably delivering a reasonable return over the next 3 to 5 years. So stable, fairly valued. Let's look at the world-class benchmarking scorecard, where we identify a company's competitive position relative to global peers. The combined composite rank that we use is a composite of profitability and growth. I call it profitable growth. And it's on a scale from 1 to 10, with 10 being worst and number 1 being, yes, I want to be the best. And here you can see that it's been stable, but slightly below average at 6. So what matters in this diagram right here is this past 12 months, and it's ranked as 6. 1 would be best. And it's just been very, very stable over time. Now, if we go down a little bit deeper and we look at the profitability and the growth, we can see that there's a couple of aspects here. First, there's been a slow margin improvement, right? It was ranked as a 7 when benchmarked against 1,000 large consumer discretionary companies. Then it went to a 6, which is an improvement. Then it went to a 5. That type of profitability improvement can drive the share price. And then we can see that growth for the past 12 months is ranked about 5, which means that it's growing its EPS about in line with the average of 1,000 large consumer discretionary companies worldwide. So about average growth. What are the risks? Well, first, we can see ongoing supply chain disruptions can create shortages. Toyota had a semiconductor chip issue, but they managed to resolve it a lot better than some of the others car companies. Failure to keep up with technological changes could result in loss of market share, and that includes the electrical vehicles, right? And adverse regulatory changes that push for more electrical vehicles could put a lot of pressure. And therefore, if we sum this up, Toyota is focused on hybrids, and maybe they're saying the world's not ready for full EV yet. They may be behind the scene. In fact, this EV skepticism could become costly in a woke ESG and EV environment. Demand rebound makes up for lost production. We're seeing a recovery there. And the ongoing share purchase program keeps return alive. Consensus is about 2292, PE ratio of 13 times, dividend yield about 2.3. As I've said, by looking at it, it's about fairly valued at this point. So not something I would go racing out to. You can also see that the share price, the blue line on the left side, the share price has actually done very, very well. And so I would be hesitant to say that there's much value there at this point. So now let's just look at this a little bit more. I'm going to, whoops, that was my mistake. Sorry, I'm learning my system here. There we go. So finally, let's wrap it up. My conclusions. Number one, production is on track and could lead to record profits. Stock dividend and share buyback offer attractive return even without the big upside. I would say it's steady. And in the long run, Toyota's got to be entering the EV space. As I say, there's a new EV vehicle that's coming out, should be out of production and for sale from what I can see from them at the end of this, at the middle of 2022. So can the world's largest car maker handle the ESG pressure? What do you think? My answer to that question is, I think they can handle it. And if you have any questions, feel free to ask. So that is the discussion on Toyota. Last week, we looked at Daimler. Next week, we're going to look at a couple of other auto companies. And if you have any companies that you'd like us to look at and value, just let me know. This is Andrew Stotts from A Stotts Investment Research, and I'm glad that you could join me in today's Valuation Masterclass case study.